we go. Hey, welcome everybody. We're going to wait just a second here while people kind of get populated in. Yep. There we go. Hi, welcome everybody. I'm Dave Etkin. Thanks for joining us for another Toolkit Tuesday. I'm Dave. I'm the director here at the Louisville Small Business Development Center. Glad you can spend a Tuesday with us, and we'll be kind of waiting a little bit while folks fill in. The room's filling up pretty much. If you wouldn't mind, as always, just to make sure that we don't have any technical problems, if you look at the bottom of your screen, you will see the chat feature. You just click on the chat feature, the chat button there, and just say hello and tell us where you're joining us from. It's always so much fun to see where we have folks coming in from. Just say hello, tell us your name and where you're joining us from. We get people from all over sometimes. There's Dale from Lexington. Good to see you, Dale. Thanks for joining. Jody, hi, Jody. Highlands, that's my neighborhood. Maybe I'll run into you there at the Starbucks on Highland Avenue. Chris from Lexington, San Antonio, Texas. Thomas, great for joining us today. Taryn, Nancy from Berea. Hello, Nancy. How are you? Thanks for joining us today. Chicago, Steve, good to see you. J-Town, Corbin, Kentucky. Colleen, good to see you. Glad you could join us today. Richmond, hi, Carla. Khalil, Bowling Green. Man, folks from everywhere. Well, thanks for joining us today. Again, I'm Dave Etkin. I'm the director here at the Louisville Small Business Development Center. You know, the Kentucky Small Business Development Center it's a national program. We have centers all over the country, and there's 13 centers here in Kentucky. So you can always find us at Kentucky, spelled out KNTUCKY, SBDC.com. That's KentuckySBDC.com. You can find a lot of information and where the centers are, and connect with a center close to you. You know, as we get towards the end of the year, it's a good time to kind of hone up on some skills, and we thought it'd be great to have one of our business coaches, Rhonda Jones. Hi, Rhonda.
Hey.
To come and kind of talk about basic financial statements. You know, at the end of the year, it's time to, you know, make some resolutions, and maybe those resolutions are to get your financials in order for the upcoming year in 2023, and do a little bit better on your bookkeeping, which is a goal I always try to do every year. So we thought we'd get Rhonda to come on and talk through all this with us. So Rhonda, how are you today?
I'm great. Thank you, Dave, for allowing me to be here today.
And so Rhonda, I'm just going to turn it over to you, and let's just get started. We have a lot to go through in a short period of time. And also, if you have any questions or comments for Rhonda, just put them in the chat, and we'll get those things answered for you, get you whatever you need, your resources. So use that chat feature, and we'll have a great session today. So Rhonda.
Thank you. And welcome to Toolkit Tuesday, Understanding Basic Financial Statements to Better Your Business. Again, I am Rhonda Jones, and I am a business coach here at the Louisville Small Business Development Center, and I meet hundreds of businesses every day. And most of those business owners do not understand what the financial statements are and how to interpret those. Now, this webinar is not an accounting webinar. It's not to encourage you to do your own books or to give you accounting skills. It's not accounting at all. It's just basically financial statements, just understanding those financial statements. And so you can make better decisions, better management decisions in your business. So I always like to start off with a quote, and this quote, it says, "Make at least one definite move daily toward your goal," by Bruce Lee. So let's take one step, and our goal is to understand financial statements and to be able to interpret those and know what they mean. Not to be an accountant though, okay? So let's go. So there are three basic, well, actually really four, but I'm just combining them into three, like balance sheet, income statement, and statement of cash flow. We do also have a financial statement we call owner's equity, but that is going to be included. That little statement is going to be included. That little section is going to be included in your balance sheet. So what I want you to just understand today is, what is a balance sheet? What does it tell you? Why do you need to know what it's telling you? And also the same thing for the income statement and a statement of cash flow. Because as you go through your, as you launch your business or as you expand your business, you have to make financial decisions. And so just being able to know what these statements mean could save you money, can keep you from bleeding from within, and actually be more profitable. For example, if you know what the income statement is telling you, which we'll go over the income statement, is you might see that your cost of goods sold maybe be a little bit too high or too low, or you may need to make an adjustment to be more profitable. So just knowing these statements, if you use a bookkeeper or accountant or some type of accounting software, those are all great, but you still want to be able to count your own money so you can make better decisions. And again, you do not want to try to develop or create financial statements from scratch. This is not what this webinar is about. It's all about you just understanding and interpreting. So our objective today is to recognize the different accounting statements that exist and interpret their meaning. Okay? And so why do we want to understand these financial statements? Because as a business owner, you want to be as profitable as possible. You want to see if you have a strong cash flow. You want to know what your working requirements are, how liquid you are, credit to fund, and operation expansion. Because if you're really liquid, you're able to take care of your short-term liabilities without selling your inventory and borrowing capital. And that's what lenders look at if you're trying to expand and get money. So the accounting equation is, you need to know that your total assets equals your total liabilities plus owner's equity. And you will see this accounting equation in your balance sheet. And the reason why it's called a balance sheet, because these two sides of the equal sign, they need to balance. So your total assets need to be balanced out with your total liabilities and equity. That would be on your balance sheet. So this is the accounting equation that you should know. So the financial equation, assets equals liabilities plus equity. Assets are acquired via two sources: debt financing, so you can get loans from a bank, vendor credit, or owner's equity, retained earnings from business profits, of money you have invested yourself as an owner. So if you're trying to get assets, these are the two ways that you can do it: your own investment or financing. So the balance sheet reflects the company's position, what you owe and what you owe and what you own. It determines the risk and return of your business. So when you're considering getting finance, a bank's going to look at your balance sheet. They're going to look at your assets, your liabilities, and how much you have actually injected capital investment into the business. Okay, so we talk about assets. So what are assets? So asset can, of course, will be cash, inventory, equipment, etc. It could be other things as well. Your liabilities are your accounts payable, loans, debt, and your owner's equity, capital investment, and also your retained earnings that you're keeping into the business. So we talked about total assets. So we have two different types of assets and two different types of liabilities. Okay, so your current assets are that can be converted into cash within a year. So it can be things, like accounts receivable that you expect to receive those monies within a year. Your cash, anything that's easily converted if you need it into cash. So that would be your current assets. These assets are expected to be converted in less than 1 year, within a year. So when you're talking to your lender or to your investors or to your managing partners, make sure you know the difference between current assets and current liabilities. And non-current assets. So your non-current assets, of course, or you can call them long-term assets. Those are longer than a year. They can't be converted over within a year. So it could be things like equipment that you may own, certain equipment, land, certain vehicles, or bonds, or real estate, or other investments made in other companies. So these would be your non-current or long-term assets. So the two of these, your non-current and your current assets, will equal your total assets, which are on your balance sheet. Okay, so total assets, again, is current assets plus your non-current assets. And of course, the same thing applies for your liabilities. So your current liabilities, of course, would be, any liabilities that you have to pay 12 months or less, and non-current or long-term liabilities. So current liabilities can be like accounts payable or accrued payroll, that you're going to owe your employees money within 2 weeks, even though you haven't paid them. They get paid every 2 weeks. That's your accrued payroll, short-term or current loan debt. Other current liabilities, for example, like lease payments. And then, of course, we have our long-term liabilities. You may have a small business loan or accounts payables or other accrued expenses that you would not have to pay until that's longer than a year. So again, anything that any type of loans that are extended past 1 year, or any type of other expenses that are extended past 1 year, are considered your long-term liabilities, which of course, then you have your total liabilities. So how do we know if you have a good balance sheet? It's a good question. So we're going to just do a little example, a ratio. We're not going to do ratios for all of the financial statements, but just a balance sheet, because we probably wouldn't have enough time, I don't think. So if you're just trying to determine whether, how liquid you are, or how you can, or if you can really pay your current liabilities, you can either do a current ratio or a quick ratio. Now, quick ratio doesn't include your inventory or prepaid expenses, but your current ratio, it does. It's usually more accurate, more conservative, because the quick ratio is just a just quick test to see if you can pay your short-term liability without selling your inventory. And that's what bankers look at as well. We're trying to qualify for a loan. So like I said, like I had mentioned, the quick and current ratios are liquid ratios. And it does show or gauge to see if you're able to pay your short-term obligations. And the current ratio divides the current assets by the current liabilities, and we'll see what that means. Oops. Oops, did I pass it up? Okay, sorry. So typically, a good current ratio would be about 1.2 to 2. And what this tells you, or tells a lender, that you have 2 times more current assets than you do have liabilities to cover your debt. So if you want to know, if you're presenting these financial statements and you want to really know, or you can have someone analyze them for you if you want, but you just want to know for yourself day to day, you can just take your Current assets, we talked about what current assets are, we know what they are, and we know what the current liabilities are, and we can figure it out whether or not our balance sheet is really a good balance sheet. So you can make better decisions. So the current ratio below 1 means the company doesn't have enough. You don't have enough you don't have enough liquid assets to cover your short-term liabilities. And this is something very important you want to know as a business owner. And this doesn't take a long time to do this. You can just maybe put on your calendar like once a month or once a quarter. I want to just kind of, take a look at my balance sheet, see where I am, how liquid am I? Or if you want to go before a lender, you want to know that you do qualify before you go, so you won't have to be denied or go or try again because you're already aware of what's going on with your financial statements. So the quick ratio measures the company's capacity to pay its current liabilities, like I said earlier, without having to sell inventory, because inventory could be sold, it's liquid, or you don't have to borrow money to pay those current liabilities. And the quick ratio is more conservative, okay, than the current ratio, which includes all the current liabilities and assets. So if a bank is looking at your quick ratio, the number, any number greater than 1 is good, okay? It's basically telling you that the business is healthy and can pay its liabilities within 90 days. And then it just tells you how to do that. What is the quick, okay, what are your quick assets? Cash equivalents, marketable securities, short-term receivables, are current assets that can be converted easily. So you take your current assets and divide them by your current liabilities. And of course, when I tell people to do that, they're like, oh, where do I find that? But after this session, you know that you go to, we're still talking about the balance sheet. You need to know where your assets and your liabilities are. How can you find those? So we're just going to do a little bit of a little problem. So this is just an example. So the Yummy Bakery has current assets totaling $150,000 and $75,000 in current liabilities. So we're going to look at the balance sheet on the next slide. We're going to figure this out. So we want to know, can the Yummy Bakery pay its current liabilities without needing to sell its inventory or borrowing money? That's what we want to find out. So the assets are 150, the liabilities are 75,000. 150,000, 75,000. Okay, so this is just a little example of a pretend balance sheet. Move this over. And as you can see, something's blocked. I can't see the numbers very well, but as you can see, the cash and the cash equivalents are 76,000. Marketable securities, I think it's 110,000, etc. Inventory is 167,000. You go all the way down until we see that our current assets are $1,350,000. I mean, our total assets, okay, of course, we know what they are because we added the non-current and the current assets, and it's over $1 million. It's almost $2 million. This is the Yummy Bakery's total assets. And so now we're looking at the liabilities here. Liabilities is $350,000. And we look at the other non-current liabilities and shareholders' equity. And we talked about this earlier, that the liabilities, the total liabilities are the current plus the non-current. Plus, we're going to add the stockholders' equity. And we remember we said that the total liabilities and equity have to equal our total assets. As you can see on this balance sheet, it does. If it did not balance, then something's wrong. So this balance sheet is okay. So let's see if they can pay their debt. Okay. So here's a quick ratio that we talked about earlier. And we said that we had to divide the quick assets by our current liabilities. As we saw on the balance sheet, the numbers here, the 76,000, 110, 230. These are our quick assets as we got off the Yummy Bakeries balance sheet. And these are our current liabilities, $350,000. And we can go back and just confirm that. And here we are, 350,000 current liabilities, and these numbers all match. So we can go back and see. And so once we do that, the quick ratio for this particular bakery is 1.19. And we had said earlier that if it's above a 1, that it's good. So what is this telling us? It's telling us that for every $1 of current liability, the company has $1.19 of quick assets to pay for it. So yes, it's it's pretty good right now. So it's looking good. So that's our balance sheet. So we talked about also, we were going to talk about the statement of cash flow. So basically, I just say, this is how I think about it: cash going in, cash going out, flowing in and flowing out. It summarizes the way the money comes into your business and how it goes out in a defined period. So all your receipts and things of that nature is all going to be under statement of cash flow. So why analyze cash flow coverage? So it's going to tell you how much debt the business is tied up in debt or investment. It's going to subtract all your operating expenses. It helps you understand whether your cash is a positive or negative. So when you go to the bank, you apply for a loan, or if you're thinking about starting a business and you're working on your projections, after you get all your numbers in, at the bottom, it's going to tell you of the cash flow statement, whether it's a negative cash flow or a positive cash flow, and how strong is that cash flow. And so there's the cash flow is sectioned out in 3 sections. We'll see how that is sectioned out, so you can see what your receipts are. And here at the Small Business Development Center, that's what we do for our clients. People come to us and they'll say, okay, I want to start a business. And so we ask them for, what are your expenses? How much money do you need to borrow to see what the payments are? What are you going to purchase with this money? And so we take this information and we create these statements, and we create the income statement. We create the balance sheet. I mean, we do the cash flow. And so one of the things we look at a lot, but we look at the end result of that cash flow statement, the statement of cash flows. What's going on with the cash? Do you have too much debt? Are you having too much debt? Are you selling enough? Is your cost of goods, if you're making enough profit, are you pricing your products or services where it covers your expenses and as it covers your cost of goods sold? So this is a very important statement. The banks really look at this statement closely, and the cash flow is so important. You want to make sure it's healthy. So let's talk about the cash flow leverage. To find out the company's cash flow leverage, just going to tell us how to do that. We're just going to divide the operating cash flow by the total debt. So for example, if you have $500,000 in cash flow and total debt of $1 million, your leverage is 0.5. The higher the ratio in this certain situation is the better. It's the better position the company is in to meet all its obligations. So if we're trying to figure that out, we can look at the cash flow statement, get those numbers, and do our ratio. So the financial leverage ratio of less than 1 is usually considered good by industry standards, okay? But a leverage ratio higher than 1 can cause a company to be considered a risky investment by lenders and potentially potential investors. The lower your leverage ratio, the easier it would be for you to secure a loan. So again, before we go into, when we help our clients with their financial statements, we look at these ratios and analyze these financial statements. So they won't go into a lender and with bad ratios, because the lender's going to look at this. They're going to look at your cash flow. And then you don't want to go into a business if you put all the numbers in, it doesn't make sense. So of course entrepreneurs are very special people. They take calculated risk. They're really good at what they do, but sometimes you need to, again, don't be an accountant, but just know what to look for when you are going forward to apply for a loan, or to talk to an investor, or just to invest your own money. You still need to know the ratios. You need to know do these numbers make sense? Is this a good idea or not? If not, let's go back to the drawing board. Let's see what we can do. Let's see what we can do as far as lowering our expenses, or starting up maybe with 1 or 2 services opposed to 3 or 4. So this is really good information for you to decide whether or not you need to move forward or go back to the drawing board, or just maybe it's not a good time. So the ratios determine the level of debt load that a business has incurred. It also indicates on how much of its assets are paid for with borrowed money. So your cash flow, it could be, even if your cash flow is low sometimes, it could be that, not that, it could be maybe your accounts receivables are maybe not coming in when they're supposed to. It could, maybe it comes in like maybe 90 days opposed to 30 days. So there's always a reason why the ratio is either good or bad. So we'll help you look at those as well. So for example, if ratio is 2.2 to 1, means that for every $1 of shareholders' equity, the company owes $2 in debt. And we want to make sure we keep good ratios, because we don't want to go in bankruptcy or go out of business. So what is cash flow coverage? It represents a relationship between a company's operating cash flow and its total debt. That's basically what it is. It serves as a metric that determines a company's ability to pay within a certain period. Okay, so how do we interpret cash flow coverage ratio? The ratio equal to 1 or more than 1 means the company is in a good financial health. Okay, a ratio less than that is an indicator of bankruptcy of the company within 2 years if it fails to improve its financial position. So even if you don't have a really good ratio, if you're already in business, it doesn't mean you have to close your business or file bankruptcy. There's always ways to improve your cash flow. So we can't really get into that today, but but there are ways. So don't get discouraged if your ratios are off or a little bit less than what they should be. So we basically, kind of talked about this already, but while a ratio of 1 is sufficient to cover interest expense, it may also mean that there is not enough cash to pay other expenses. So you have to be careful with that as well. So business owners should aim for a ratio of 2 or above, which means the interest expense can be covered 2 times over. So we just have a little example here, just cash flow coverage ratio. So we have the operating cash flow total debt payable during the year. So if we take that cash flow coverage ratio, because there's different cash flow ratios, if you take that 50 million divided by the 23 million, it's 2.17. This formula is the earnings before interest and taxes and non-cash expenses, which is divided by interest expense. So this is a little much for you right now, but I don't want you to think you have to memorize and know these ratios. I don't know them by heart, but the thing about it is when want to analyze your financials or look at your financials, you just have it where you get your hands on it. We're not trying to be experts, but we want to know that where we can get the information and how to use the information. Because you are focusing on what you do best, your business, your restaurant, your whatever service you're providing. And you're not trying to memorize all these ratios. You just want to know what they mean and how to use them. So this is really good. Everybody wants free cash flow. So free cash flow is money a company has left over, okay? After paying all its operating expenses, capital expenditures, the freer the cash flow a company has, the more it can allocate to dividends, getting out of debt and other growth opportunities to expand, to provide more jobs, maybe to open up a new location. So you want to have a really good cash flow. It's just a little example of a cash flow statement. It's nothing really special, just really basic. So in the beginning, we started off with no cash. And so we invested $1,000. We sold 200 in sales. So our total receipts in the first section of our cash flow is $1,200. But we also had to make some payments. So cash went out. Okay, so we had to use some bills. We had to pay our utility deposit. We had expenses we had to pay of $150. We had a debt we had to pay of $400. So our total payments going out is $650. But we brought in $1,200. So we have our total receipts, we have our total payments. And so the cash flow for the period is $550, which is just the difference between the total receipts and the total payments. So this is just a basic, simple one. The ones that you really see have a little bit more detail, a little bit more information, but it just shows you how the cash flow statement should flow. So right now, this business has a really positive cash flow of $550. So that's a good thing. So now we're going to talk about the income statement, which is a summary of your business's income and expenses over a defined period of time. So let's look at that. So on our income statement, we're going to have our revenue. So we're going to have our sales. How much money did we bring in? And then if you have like a product that you sell, you're also going to have a cost of goods sold on the income statement, because maybe you made $500,000 in revenue, but maybe it cost you $100,000 to make the product. And that's not in the expense section. It's going to be a cost of goods that's added to the income statement to show what are you paying for the product that you are selling to your customers and clients. And then we have all of our operating expenses on the income statement. Your lease payment, your utilities. You're going to have insurance. All your business, all of your operating expenses you'll see on the income statement. And then you're going to show whether or not you have a profit or a loss. So it's just a summary of your income and expenses over a defined period of time. And again, I talk to business owners or people who want to start a business, and I ask them what their revenues are, or whatever, and they don't have any idea where to find this information. And all this, the purpose of this, remember, is just I just want you to recognize what the statements are, and know what they mean, and how to interpret them. So this is our income statement. So your company sales or revenue, cost of sales, I call it the cost of goods sold, which is the same thing. It's the cost of products sold, which it can include materials, depending if you making things, or it can include labor. It can include overhead on your cost of sales, your cost of goods sold. And then of course, we talked about that already, your expenses, and we have our net income. Hopefully it's a positive net income. And so just a reminder that it describes your business financial transactions over a period of time. So normally When we do our financial statements for our clients, we do a 3-year projections out. And it tells us, if they give us all the expenses, sometimes they say, well, I need to go back to the drawing board because it's not profitable. So is your business making a profit? And if so, how much? And if so, what is your profit margin? And how does that profit margin compare to your competitors? How does that profit margin compare to the industry average, locally and globally? So if I'm asking you, what is your profit? What's your net profit? What's your profit margin? I want you to know where to go to get that. How does this net profit compare to the, I just said it. Okay, so are your sales increasing or decreasing? Because it could be seasonal, like some products or services are seasonal. I can get that out, I'm thirsty. But how does it compare? And what's your benchmarks? And are you growing? And so I know you first start out in business that you probably are not going to be as profitable in the beginning. It might take you, 6 months to a year to really see some really good profits, but you want to be able to look at the industry benchmarks and see if your prices are, your profits are increasing or decreasing, and you might have to make some adjustments with maybe you might have to negotiate with the vendors that you use to make these products to get that profit that you need to make. And are your expenses, if your expenses are increasing or decreasing, why? And what about labor costs? You have to look out. This income statement gives you a lot of information, and you look at these statements. So you need to make management decisions. You need to make decisions. Know how to count your money. Know where your business is, and where you're going, and look at the trend. What's trending with your business? And then as you look at your cost of goods sold, and you see that this particular service or product is really popular. This is my main service or product. This is where I'm making the most profit. And then maybe the vendor you get into information or getting the materials from, maybe you can negotiate and get even a lower cost from the vendors if you are using a vendor to even increase those sales even more, just by looking at your income statement, looking at your cost of goods sold, looking at your expenses, looking at your labor costs. You are making decisions as a manager, as an owner of a business. So you are in business to be successful, not to lose money. And sometimes we fail. That's okay. We learn from our mistakes and we get up and we keep going. And this is just a little example of an income statement, just a very, very basic. Okay, we made $500 in sales this month or this week or around whatever time period this may be. But it costs us $150 to make those sales. So my gross profit right now is $350. That's pretty good. However, I do have expenses. I do have to pay my liability insurance and my business phone and all these other expenses that I may have. And then, that equipment that I have, this is depreciating. That truck I had to buy for my business, I'm paying depreciation on that. That's an expense. So after all of my total expenses, my operating expenses, and any depreciation that I may have, et cetera, then my total expenses are $200. So I have to pay those. So my earnings, this is even before tax, 150. It's before we take taxes out. So it's probably going to be like $100 or something, or maybe less. But this is a very basic example of an income statement. So we're just going to do a little bit of review. So we've covered a lot. And again, we're not trying to be accountants. We're not trying to do our own books. All we want to know is what these statements are. What do they tell us? And how to interpret those statements. So we said that on the balance sheet, we're going to have our assets. It's what we own. And we said that we have current assets, which are assets can be converted easily within a year, within 12 months. And we have our long-term assets, which are longer assets that we may have, like land or equipment, et cetera. And also we said that we have liabilities, that what we owe out. And we do have our liabilities that we pay within a year, and then we have, of course, our long-term or our non-current liabilities as well. And owner's equity is basically what's left over for the owners. But what does it tell us? It tells us basically the status of a business at a given point of time. What's going on with this business? How strong are they? Do they owe out more than they own? What's going on with this business? And all these statements, like I said, lenders look at it, investors look at these statements, and it tells a lot. So what is the status of a business at any given point? You might want to go to your balance sheet and look at your assets, what you own, what you owe, and owner's equity. As a business owner, you need to know. If someone asks you what a balance sheet is, you should be able to say, okay, I know my assets, liabilities, and equities on the balance sheet. I know what it's telling me, the status of my business at any given point. How much debt am I in? How much do I own? What do we really have in the business? Okay, and so our income statement can tell us how much money are we generating, our revenue, what are all of our expenses? Are we having gains or losses? And if so, why? And how can we improve those gains or not have losses? And in order, you just can't oh, I don't know what to do, I don't know what to do. No, because we know that we can look at our income statement and make really good decisions and manage our business the way it should be managed. And also, like I said before, you'll see the cost of goods sold on the income statement. What does it tell you? It tells you the operating results of a company during an interval of time. So usually we do our projections or our income statements is for 12 months, maybe 3 years out. But you want to make sure that, in my opinion, that at least every quarter should be like an appointment on your appointment book. It should be on your calendar, okay? Because it's important, because you are in business for your family, for your community, for yourself. So on your calendar, if you choose to do it quarterly, monthly, or weekly, whatever you choose, depending on your business, you want to have it on your calendar. Okay, I'm going to look at my income statements to see if I need to make any adjustments, if I need to make any changes. So what I need to do to be more profitable. Okay, our statement of cash flow, some of which is called net cash flow. The first section of the cash flow statement is talking about the cash is going out, all the business activities, operational business activities, going to be on the first section. The second section of the cash flow statement is going to have the results of investments, gains, and losses. And the final section, which provides an overview of the cash used from the debt and equity. And the bottom line of that cash flow statement is going to show a positive cash flow or a negative cash flow. And if it's really low, then you want to see why. It could be a number of things. If it's low, then, like I said, we don't want to be experts, then you bring it to your accountants or your bookkeeper or somebody's attention. If my cash flow is low, let's sit down and figure this out. Because your accountant is not responsible for managing your business. Not saying, oh, hey, by the way, your cash flow is low, or by the way, you need to make some adjustments. It's up to you as a business owner. It's up to you as a manager to, like I said, to be able to know what these statements are, to interpret them, not be an expert. And if you see something that it's not right, that's a negative, you need to know where to go to analyze it, either by ratios or going to your CPA, your accountant, your bookkeeper, someone that can help you figure out, okay, what adjustments do we need to make? What changes do we need to make? Instead of being, reactive, we're going to be proactive and stay on top of the very important activity is looking at your statements on a regular basis. So the benefits of understanding financial statements are, you're going to monitor your business activities, which is great. understand the financial outlook. You can make goals, you can set goals, make changes, maximize your profit-given activities. We're going to maximize those profit-driven activities because we are staying on top of it. We know we're looking at our assets on our balance sheet. We're looking at our cost of goods sold because it's our responsibility. It really is. It's our responsibility. So we can identify problem areas. And also these statements provide vital information to partners that you may want to go into business with you, investors and banks especially, because they know what to look for. And so it's one of the advantages working with us at the Small Business Development Center. We can create those financial statements for you and we can look at them together and before you go to a lender and say, hey, let's kind of look at these ratios. Let's kind of see what's going on with your projections. Does this make sense? And one thing that's really important is it helps you plan for the future. And you have something to go by to see, hey, you know what, I really could use an assistant. I really could, open up, provide another job opening for someone because you understand the numbers, you understand, what are you looking at? So you can create another job or you can give yourself a raise or, do something like wonderful for your family or community because you understand the numbers. You understand what these financial statements are. And so I was talking about when we work with our clients to calculating sales forecasts. So this information helps us and helps you to forecast, to see, okay, we looked at our competitors, we looked at the numbers, we did our research on the costs, we know what we need to buy. And so therefore we can make realistic sales forecasts to be able to launch our business, to go to get funded. We know what it takes for us to break even. We know how many units we need to sell and whether the price or volume of both causes a gap between expected and actual results. Okay, so, and studies show businesses and entrepreneurs who know the basics about the financial statements, know what they are, and know how to interpret those, their survival rates are higher. A really good 80% of those businesses who start or are already in to expand, 80% of those businesses survive. If you just have like an average knowledge, okay, yeah, I've heard of that, you still can make it, okay? Average, these are just numbers the surveys that's been done. But if you don't know, if you're inadequate, then your chances of being successful are lower because you are making bad decisions, because you're not taking the time to recognize these financial statements, know what they mean, and to interpret them. And if you don't know anything about them at all, you're just going to business, don't know, you're a business owner, you launch a business, what's it about? What's a financial statement? You don't know what's on those statements, you don't know how to interpret those, the chances are poor for you. They're very low. And it's risky business going into business, but if you do a calculated risk, or if you do your due diligence and you educate yourself and you learn, because you're good at what you do anyway as a business owner. You're good at, at your restaurant cooking, or good at, whatever you do, you're so good at it, at doing hair or doing nails or whatever you do, whatever you're providing to the people. You're providing something to the people that they want or need. You have a solution to a problem, and all that's great. You're talented, you're skilled. And again, we're not trying to make you experts or accountants. This is not accounting. We just want you to be able to count your own money. I don't care how big you get or how small you are, you need to know what those financial statements are. So it's important to recognize and understand and interpret financial statements as a business owner. You will take management action to make things happen, provide you with a health check on your business and how the company is doing financially, using those ratios we talked about. And there's other ratios, but of course, we don't have time to go through all the ratios. There's other ratios you can use. You can Google those, or I can send those to you if you want more ratios. It gives you a snapshot of where money is being generated, which is very important, and how you are spending it. How's it going? Can we cut back on that spending? So all this makes helps you make better business decisions. It makes you feel better, more confident, more optimistic, more hopeful, and it just gives you the upper hand on operating your business. And just as a reminder, you're making decisions. You can you ever expect to make a good decision based on incomplete information? So you should make a decision on what should I do with this product, or should I increase the price, or should I eliminate it? But if you have incomplete information, you're not going to make a good decision. So your financials are your only source of complete information about your business. Okay, so for better financial statements, it's always better to use accounting software. Like I said earlier, we don't want you to do your own books. You need accounting software. You need your CPAs and all those financial people to help you, file your taxes and so forth. But you still need to know how to read them so you can count your own money. And okay, it leaves us 10 minutes for questions. We'd like to answer your questions, and hopefully that you will visit us on our website and come and see us sometime.
Mhm. Thank you, Rhonda. That was a lot. You jammed a bunch in 50 minutes.
I know it was a lot. I hope it wasn't too much, but they can always reach out to us.
Yeah, that was great stuff. So if you have any questions or anything we need to clear up or some comments, just put them in the chat and we'll throw them out to everybody. So yeah, there's Rhonda's contact info up there, and if that calendly.com link, you can actually go to Rhonda's scheduling page and get right on her calendar. Don't have to do anything, just look at the calendar, see what works for you, and Rhonda will be there waiting for you on Zoom to do a nice one-on-one coaching session for you. So, but if you have any questions or comments, just put them in the chat and I'll share it with Rhonda. We'll get them answered for you. But so Rhonda, you talked a lot about ratios. What do you think is like the most important ratio? Something that, like, if you were going to start doing that, where would you want someone to start using ratios? What would be the most important one for them, do you think, to start drilling into, do you think?
I think you should use ratios when you first start, when you're working on your income statement.
Mm-hmm.
I think that's where you should start, because you're looking at all your expenses and your income and see whether or not you are profitable and see if it really makes sense.
Mm-hmm.
Mm-hmm.
Okay. That was a really good slide too about the likelihood of survival, based on accounting records.
Mm-hmm.
So where would you like, if someone hasn't been keeping good records, where would you recommend that they start? What would you think they should do first?
I think they should, first of all, hopefully they're using like accounting software or good CPA or bookkeeper, and just ask for those main statements and look at those statements, especially the income statement and the cash flow. Well, all three are very important, but you want to see if your expenses and your cost of goods sold are in alignment with, your competitors or what's going on in the industry. See if you can cut back on cost and expenses, and see what your profit margin is.
Mm-hmm. Okay. Robert asks, do you have a checklist you can give us to gather information we need?
I can provide that. Yes, I can provide a checklist for, I guess, for what you need to, I guess, check your books, or to start off trying to see what your statements are healthy or not.
Yeah, I guess, I guess a checklist, a way to organize, the information so you can start calculating the ratios easily.
Yeah, I'd be happy to. I can provide you with a list to get you started.
Okay.
It's never too late to start. You only know what you know. And most
right.
business owners are so good at what they do. They're just so good and talented, but they kind of overlook this part. And
Right.
I understand that, because it can be overwhelming. You're busy, and it can be challenging to look at a cash flow income statement and trying to figure out what what they're really telling us, but I just think it's worth the time to learn those three basic statements and to understand what they're telling you, and to be able to interpret those statements.
Yep. Khalil asks, what are common mistakes beginners make when analyzing ratios and statements?
I think a common mistake would be sometimes you can look at your cash flow and think it's, it's really strong, and it may be, but you want to even just don't look at the bottom line. Okay, you want to look and see. Though you want to look at those receipts and look at those and look at your debt. Don't just say, okay, the bottom line. The bottom line is important, okay, but you want to just be able to understand why the bottom line is either strong or negative. It's not just something. Oh, it's strong or negative. Why? And figure that out and use those ratios.
Yeah. Let's see. Nubia says she would like a list of different financial ratios for use. So yeah, there's a lot of them.
I recommend. I have some ratios that I do recommend, and I can forward those to you.
Yeah, ratios you can make up yourself too. You don't have to use. It's not against the law to make your own. So we, back in the day when I was in the restaurant business, we would use ratios like we called a check average, and that would be the number of customers divided by total sales. So that was a ratio right there that we made that's only good for if you own a restaurant, basically. So, you can come up with your own stuff if you want to.
Yeah, you can be creative.
Yep. So I don't see other questions, and it looks like we're right at the top of the hour. Our time is about up. So Rhonda, thank you so much for doing that. And you did a great job, and that was a lot.
It was a lot, and I just wanted to say, just reiterate that we're not trying to be accountants, or this is not accounting, and we're not trying to say you should be an expert. We just want you to know the basics, because it can save you a lot of money and keep you from making mistakes and help you be more successful. Then if you just take the time just to learn the basics of the financial statements. That's all I know. I'm not an accountant. I don't even, I started out in school as an account major. I quickly changed it. So, but I do understand the basic financial statements. And so I think every business owner should.
Yeah, I totally agree with you. Well said.
Yeah.
All right. Well, thanks everybody for joining us for another Toolkit Tuesday. And I hope you have a great Tuesday today. And we will see you in a couple of weeks, because we're going to take next week off, aren't we, Rhonda?
Absolutely.
So happy holidays, everybody. And we'll
happy
see
holidays.
you guys in January. So bye, everybody.
Thank you so much for joining us today. Thanks, Dave.
Bye, Rhonda.
Bye.